Santosh Das Kamath joins us, Managing Director and Chief Investment Officer with the Fixed Income Group with Franklin Templeton. Santosh, first, happy Diwali. Thank you for joining us.
Thank you very much.
Lot of commercial. Thank you very much. We reciprocate the same. A lot of commercial paper is due for rollover in the month of November. Mutual funds have hit their sectoral limits. What's going to happen now?
I don't think that view is correct. I don't think mutual funds have hit the sectoral limits.
Okay. That's what we read in what brokerages are telling us.
I think you should change the brokerage report which you read, because I don't think there's a big issue in rollovers.
Okay.
So let me give you some perspective on this NBFC issue. Happened couple of months back. The first key thing people should understand is that the way the NBFCs are structured in India, most NBFCs, we should not say all NBFCs, with a 15% capital adequacy requirement, which means that your debt to equity can't be more than 6 times.
Okay.
If you're slightly more conservative, you'll keep it for 4.5 to 5 times. NBFCs don't go insolvent on the asset side issues. Okay. So at a 4.5, 5 times debt to equity, your losses has to be 25% of your book for you to go insolvent. Okay. Right? Because 25% is equity and 75% is debt, and therefore 25% losses. In 08-09 also, which was a huge economical issue worldwide, the NPAs were 3-4%. Yeah. So we are long way from a 25% NPA, and therefore most of the good NBFCs, or most of the NBFCs, I must say that they will be solvent. When the company is solvent, the company can only face a refinancing issue if there's some issue which comes up. So most of the NBFCs which are there in the market for the last 10-12 years would have seen 2008, 2009, and believe me, today is nothing compared to what it was in 2008, 2009. They would have seen 2013. So any NBFC which has seen 08, 09 and 2013 understands that capital market is a very fair friend. You may, capital market likes you, you'll get lots of money. Capital market doesn't like you, so you don't get too much money. And therefore you need some backup of bank lines and so on and so forth. So
would you be rolling over all your exposure which you'd given to NBFCs as a mutual fund? I mean, are you, what I'm trying to understand from you is that, and correct me if our interpretation is wrong, mutual funds got a lot of inflows post demonetization. Yep. NBFCs, they got a clean wicket because they wanted to grow and they got credit line from mutual funds. So it was a very nice, cozy relationship which has worked well for the economy because the credit growth was able to grow. Now, NBFCs may face an asset management, asset liability mismatch. Right. Mutual funds who were readily giving money to NBFCs, they may be reluctant. Right. That's our broad understanding of the subject. Right. You can feel free to agree with me. You can feel free to disagree with me. No, if you disagree with me, please explain why.
Yeah. So I may not agree with you on totality. Okay. So it's always seen as if mutual funds are helping NBFCs. That's the way it comes out, right? Believe me, mutual fund also needs this NBFC as badly as NBFCs need this mutual funds. Of course. So in the last couple of years when the credit growth was not happening, a large amount of money was coming in the mutual fund, the good credit to lend to was NBFC. As I said, 15% capital adequacy, a decent promoter background, decent asset book, and therefore mutual funds are very keen to participate in NBFC sector because that's the only sector which was taking money. I think that's not going to change. Okay. If you suddenly think that NBFCs will go below the radar and banks will come up, I have my doubts on it. I think NBFC will continue to be a large player in this increasingly, when the credit demand is picking up and your banks have, some banks have equity shortage, some banks have deposit shortage, some banks have under PCA, private sector banks, we are seeing some leadership change somewhere. So net, NBFCs will continue to be a dominant player, and believe me, they are a very smart set of people. When I meet many of these promoters, the only drawback according to me, when I meet many of these promoters of NBFCs, most of the promoters are focused on the asset side. So they will put huge amount of effort to make out what NPA do I make, which sector do I lend to. There are few promoters whom I meet who are equally focused on the liability side. Now, when I meet the promoters now, they are saying, okay, asset can wait, let me look at the liability side. Once they handle the liability side also equally well, I think things will be perfectly fine. But from equity market perspective, I think you guys are asking me the wrong question. The cost of equity is going to go up. Yeah. And if a cost of equity goes up, with the same ROE, with the same growth, your equity prices can fall down by as much as 20-25%, only with cost of equity going up by 1 percentage point.
That's Buffett, no classic Buffett, that if interest rates, they act like gravity. Right. If interest rates, they go higher, equity valuations
have to come lower. 1% higher cost of equity, with the same ROE and the same growth, can pull your prices by 25%. Same ROE, same cost of equity, 1% growth coming down, can pull your prices by 15% down. So people don't understand there's so much of importance we should be giving to cost of equity. Yeah. And what's of cost of equity? Cost of equity is nothing but cost of debt plus something. Yeah. Cost of debt goes up, I think cost of equity goes up and the prices come down.
So, based on these kind of interactions that you've been having with the promoters, do you think that first of all, was there a systemic risk in place, or did we just overplay it to a great extent? And is there confidence now coming back?
So for any industry, if you suddenly stop the raw material supply, obviously any industry, whether it's steel or power or coal, anything will obviously there'll be a disaster. So if nobody lends to NBFCs or banks, obviously there's going to be a huge systematic issue. But all those kind of exceptional thing works for a couple of days, and then sanity prevails, and then normally things starts coming back. I was very happy when RBI came into picture, when NHB came into picture, when Ministry of Finance came into picture, and believe me, if 3 or 4 large regulators just come and say that they are watching it carefully, right, and we'll do what is necessary, I think things will be okay. And exactly what just happened. So I don't think anyone has put a large line. So obviously banks are buying some pools from HFCs and so on and so forth, but nobody has got a big line. But because the way it's come out, the confidence has come up, mutual funds are giving new money, everything is going perfectly fine. 70-80% is perfectly fine now.
No, I'm very clear. I mean, the channel, we took a very responsible stand, and that was guided by the fact that, look, this is not a liquidity crisis, this is a confidence crisis. Absolutely. And the confidence crisis is a matter of opinion, right, which could be sorted. I mean, things are being fixed. Avan, private banks apparently have been lending to NBFCs now. Right. The RBI has opened credit line. NHB, I don't agree whether they've increased the quota, but the norms are still not very, conducive for NBFCs to borrow. So I'm going to just first clear the air. As a house, do you have exposure to IL&FS?
No.
You don't have exposure. Okay. So that let's just put that, aspect aside. Let's move on to the
But if you can ask
question.
me, why are you asking me that?
I'm genuinely trying to ask
why I'm asking you, why you're asking me is that, so mutual funds have 10 lakh, 11 lakh crores of credit book, right? Total credit. Some are AAA, some are AA plus, and some are AA. I think one IL&FS happens. Obviously, it's a bit negative, but it happens in all the markets. You have GSEC prices coming down by 10%. You have equity markets falling up by 10%.
No, my job is to first clear the air.
Okay, sorry. So if you're asking me, so we don't have any exposure, but don't give overweight. I don't think we should give IL&FS. Obviously, it has some impact, but is it a huge impact that's going to impact the entire mutual fund industry? Definitely no.
Well, I didn't do it. It was some mutual fund which sold their DHFL paper at 13%. They created the panic. So obviously, the IL&FS issue had impact, right?
No, Nikunj, again, let me just clarify that. One security getting sold at X percentage, believe me, it's not a big thing. Because the markets are not very liquid, we are on open-ended funds, suddenly you see a large redemption happening. You need to sell at a price. And if that price is 1% higher on a 1-year paper, I make 1% haircut and sell it off. So I think because it came in the background of IL&FS and all that, I think it became too much of a noise. But otherwise, a mutual fund selling something because some redemptions are getting hit, you need to reduce the exposure, big deal. That 1% is not a big deal. But if it comes in that perspective of background of IL&FS default and all that, and then obviously the noise gets bigger, but I don't think that's a big issue.
Okay. My next immediate follow-up question would be, do you think there could be so let me put some data here. The credit growth for banks was less than 10%. Right. The credit growth what NBFCs have enjoyed has been 20%. Right. NBFCs will have to slow down. Yes. Whether they do it by 10%, 5%, 15%, that's a debatable point. Yes. Credit offtake will be taken by banks. I expect corporate banks to start gaining some market share. Right. But where do you think the aggregate picture would grow? NBFCs will slow down, banks will pick up. Where do you think the middle path would be for the credit growth? So
I think NBFC industry will slow down, but believe me, smarter NBFCs will take this opportunity and they will grow faster than what they're growing. Because what happens whenever there's a bit of negativity, large amount of money goes to NBFCs where the perception is very good. Perception. Forget about reality. Perception is very good. Those NBFCs, they are going at 25%, they may go at 28% now because more money is chasing them. And they are very smart set of NBFCs. I've been dealing with them for the last 15, 20 years. They are very smart. They know when to borrow from capital market, when to go to bank, what level to give. They are very, very smart set of players there. I don't think any smart NBFC will even see the growth coming down. But having said that, I think the bigger picture we are missing is that generally I think the economy will face significant headwind going forward. There's one data point which I think is a huge data point worldwide has got unnoticed. I was just reading yesterday a report which said that China, after running a 10% current account surplus in 2008, last quarter was a current account deficit. Can you imagine the impact of a China going current account deficit? That will impact the currency of China. And if you impact the Chinese currency, can you imagine the impact on the emerging market currency, including ours? I think those are bigger issues. NBFCs will come and go, but if your macroeconomic headwinds are high, if US growth is very good, if US rates are going up, if our currency is depreciating, I think we have other things to worry about rather than this NBFC issue.
So, in the larger picture, just want to understand, this is something we were discussing earlier. Were we a little bit late in the curve in terms of spotting what has happened or what unfolded? I know you said that there was a lot of noise around it. And what is now going to be the outlook?
Now outlook is, I'm saying, slowly the panic spread is coming down. So over a period of time, the spread which widened because of panic will come to close to zero. So the panic spread will go off. But having said that, mutual funds, again, this data is not very widespread known. Mutual funds lost 1 lakh crore AUM in fixed income in last 1 year.
Yes,
that's a large amount. So if the economy is growing, if you need more credit to go to economy, other hand, mutual funds are losing 1 lakh crores. And why did we lose 1 lakh crores? Because we got extraordinary money when the demand happened, and the currency is going back, liquidity is a bit tight, and this money will go off. Week on week, month on month, fixed income funds have been losing assets. Therefore, while the panic spreads will keep coming down and become to zero, the normal spread on credit spreads will keep widening, because mutual funds are the biggest movers, fast movers, on both on upside and downside. So as you said, some mutual fund is getting redemption, they will have to sell it, corporate paper at a 1% higher yield, they will go and sell it. And therefore, they will move very fast. I suspect the bigger problem is cost of spreads going up, cost of debt going up, cost of equity going up. I think that will, and your elections coming up and US issues.
Why were the challenges with some liquid schemes also? In the industry, what we picked up is that,
right.
I'm not getting into names here, we should not get into names on this forum, but imagine liquid funds losing money. That just creates panic.
Yes.
And this is a fact. This is something which you and me both are aware of.
Right.
So what would be a message for someone who's kept money in liquid fund? Because liquid fund by default are programmed not to lose money.
You may say that, but my view is that if you lend to anyone other than Government of India, there's some chance of a default happening. There's some chance. You may say the chance is low if it's a AAA. So if you want no defaults to happen at any point of time, please go and do a CBLO fund or a T-bill fund. If you're lending to any company which is not Government of India, obviously there's some chance of losing money. Now, why ILFS was a big issue? Because it was a AAA rated entity which went into default. If it was a lower rated entity went into default, it was perfectly okay. Now, somebody can ask, why was AAA entity went to default? Now, again, I'm not here to justify what credit rating agencies do, but I worked with the credit rating agency. I can give you some color on what would have happened in ILFS. This is my thinking. I don't know too much about, because we don't have exposure there. So when a credit rating agency looks at a company and says what rating should we give, there are two broad things they look at. One is how good the finances are, and purely on the cash flows, will I get my money back on time? If the chances are very high, I'll get a higher rating. If the chances are low, I'll get a lower rating. More importantly, apart from this, they'll say who are the promoters of this company. A strong promoter and a weak finance can give a very high rating, because the promoters have shown over a long period of time that they can keep funding, putting in equity and debt, and therefore large industrial houses of the country, if they have a weak company or a slightly weak company, the company gets a higher rating. In ILFS, I suspect, because your promoters were Government of India entities, the belief was if there was a short-term mismatch, right, because these are large companies, they're AAA rated companies, they would come and put some equity or they can help some refinancing. Now it's a 0-1 game. Till the time you believe that will happen, the rating can be very high. The day that belief goes off, the rating can be low. I suspect in this case, the belief was because of the promoter background, the rating was kept high. Now, it's a debate whether it should have been a AAA or AA plus. But the rating was high because of and it's a 0-1 game. You can't have a sliding kind of rating for this. It became, and therefore there was issue.
The promoters and the backing that really gives you a futuristic view on cash flow. So I'm going to wrap it up. This very interesting conversation. We should interact much more actually, because you've managed to break up complicated things very easily for our viewers. So the fear which everyone had about NBFCs or select NBFCs going belly up because of liquidity or because of non-availability of CP paper in the market, do you think that should be dismissed?
So we can't say for everyone, but for majority of the players that is behind us, and now the rates are coming, the panic spread is coming nearly zero. But having said that, could be a couple of names. Obviously, which will be the last one to come up. Don't ask me who those names are. But 80-90% of the industry is perfectly fine. 5% of the industry will, I think, take six months more time. But can there default happen there? I suspect. But again, accidents can happen any point of time. It's a non-zero probability, but that probability is very, very low now.
Mutual funds are likely to not reduce their commitment towards CP. Is that your take?
See, mutual funds are very competitive animals. So you don't know how much you know these fund managers. So if I don't lend to a new company and I keep money in CBLO, I get 6 quarters the yield. If I lend to a decent NBFC, I get 8.5. A 200 percentage point difference between an overnight and a 2-month, 3-month CP can lose my 1-year bonus. I can lose my 1-year bonus on that. So do you think I will? So obviously, a huge amount of panic fear that will go off. But as soon as a bit comfort comes up, one NBFC, one mutual fund comes in, second comes in, third comes in, and over a period of everything come back.
Where do you think the 10-year paper would settle eventually?
The 10-year GSEC?
Yeah.
If I knew that, I would not be in a corporate bond.
You work with the assumption, right?
But I think there are many moving parts. So I get surprised when people give a view where it's going to be on 31st March or 31st April, 30th April.
So just a general trend.
I think the trend is upwards, if you ask me. Because I think I'm much concerned about the macro headwinds.
North of 8%?
Again, you can't put a number, but I think it should be over 8% over a period of time, because there are significant headwinds. 1 or 2 election surprises, 1 or 2 currency surprises on China, I think can impact us very badly.
Santosh, we've really stretched our appointment with you, but only because it's been such an interesting conversation. So thank you for coming by. And yes, of course, we hope to interact with you a lot more on this forum and on the channel.